Are you confused about filing ITR-2? We simplify it for you. Welcome to TOI Wallet Talks. It's the income tax return filing season, and as a salaried individual, it's very important that you get your ITR form right. Is it ITR-1 or ITR-2, and under what circumstances should you be opting for ITR-2? Is it capital gains on mutual funds or shares or sale or purchase of property? Giving us her insights on this is Parizad Sirwalla of KPMG in India. Welcome to the show, Parizad.
Thanks, Smriti. Thank you for having me.
Discussing a very important topic today because ITR-2 can be very complicated and daunting for a lot of people. So we are trying to understand under what circumstances is it that ITR-2 is applicable and what are the things that you should be looking out for when you're filing ITR-2. For most people actually file their tax returns under ITR-1. So what are the most common circumstances under which they should know that this year they have to opt for ITR-2?
Sometimes the common myth prevailing for individuals is that ITR-1 being the simpler form, I should just fill that. But actually, it's not the case. And since you specifically asked me for ITR-2, let me just run you through the circumstances. Which individuals having what classes of income have to necessarily opt for ITR-2. Okay. So first of all, as a general rule, ITR-2 is a form, which is income tax return form, which is applicable to individuals who don't have any business income. So if you have business income, this is not the form for you. Okay. And if your income exceeds 50 lakhs of rupees, then compulsorily you have to file ITR-2. Okay. You can't go under ITR-1. Just in case you happen to be a director of any company, then also you have to file ITR-2. Okay. And if you have, for those of us who have real estate investments, if I have as an individual more than one house property, then also I cannot file one. I have to go under ITR-2. Capital gains, these days everyone has purchase and sale of shares or any other financial investments. So if I have income from capital gains, again, I have to go under ITR-2.
Okay.
Now, if you are a cross-border mobile employee and if you are a resident of India, but by virtue of your employer having sent you somewhere and you have been exposed to taxes in some other countries and therefore you want to claim certain tax treaty benefits in your income tax return in India, again, ITR-2 is the form for you.
Okay.
Same way for residents of India who happen to have global assets, just in case you made some income and assets when you were working or staying abroad, you again have to have ITR-2 because that's the form.
Okay, is ITR auto-populated in the sense? And if it is, then what are the things that I should be cross-checking?
Most of the return forms come pre-populated and they are basically available to all the registered users of the e-filing portal.
Right.
So, when you go there, most of the forms, including ITR-2, first of all, comes pre-populated with some basic details. And what are those basic details? Your name, your date of birth, your Aadhaar, residential address and telephone numbers. This is largely the personal details or the basic information that comes pre-populated. Over and above that, your salary income details from Form 16, Part B, then you have these days your entire life or your financial transactions are through the forms 26 AS and AIS. So once you select the online option and the relevant schedules, most of the information of the income on which tax has already been deducted at source, even that comes pre-populated in the form. So whether you have Indian dividend income, Indian interest income on which TDS has already been deducted, that comes pre-populated in ITR-2. Sometimes we've seen practically, savings bank interest. So if you have savings bank interest, at times that's not an income on which tax has already been deducted at source. So those kind of incomes may not be auto-populated at times in the ITR-2. So hence it's always, to your precise question, while most of the income on which TDS has been deducted is populated prior, it is still very prudent for you as an individual taxpayer to check each and every item of your income with your backup documents, whether your interest certificates, your bank reconciliation statements, your broker statements, everything that you may have as a backup depending on your stream of income.
Coming to what you were saying about the annual information statement and the Form 26AS. So between my ITR-2 and these two documents, what is it that I should be tallying?
Now, this annual information statement, I've seen over the last 2 years, is a fairly detailed statement. It in fact gives you all the data of almost all your financial transactions, your incomes, your investments made, any foreign remittance that you may have made as a taxpayer during a particular financial year. Over and above that, it gives all the TDS or the tax collection at source details. It shows all practically the interest, dividend, stock market transactions, including purchases made. So purchase, sale of Indian listed stocks, everything is covered. Mutual fund transactions is largely contained in this AIS. So of course, you should go through that document carefully. And if you feel it's your data, so if you feel there is a mismatch of information, then you as a taxpayer also have an option. There's something called an Insights portal. You please go and provide your feedback and get that AIS data corrected to start with. Then there is a Form 26AS, and largely between this AIS and 26AS, you will find certain overlaps, on what is reported there. But 26AS also will have details like your advance taxes paid during the year, specified transactions. If you've got a tax refund of any particular past year and you have an interest on your tax refund, 26AS will report that as well. Any purchase or sale of property, largely 26AS will also report most of the similar data. As I said before, when you fill the ITR-2, it is always good and prudent to cross-check the information pertaining to your various sources of income. You are the best judge of your income streams. So let's say if you have salary income, you will have your Form 16, you will have your pay slips, your salary-related components and deductions. Just keep cross-telling all these documents with your base documents. If you have rental income, you will have your rent agreements. If you're staying on rent, you know what rent you've paid, so on and so forth. If you've sold certain assets, while you have it in all the data in the AIS and the 26AS, you will have your contract notes, you will have credits in your bank statements. All in all, it would be good to just cross-tally with your base documents like this, just so that, including credits in your bank account, just so that when you fill the annualized income tax return in ITR-2, there is no scope for any omission or errors, and you're absolutely, it's full proof that you've checked, and dotted all your I's and crossed all your T's.
Right. So for ITR-2, what are the most common sources of capital gains that I should be aware of?
So the most common sources of capital gains that generally any individual taxpayer would have, Smriti, would be, as I said, if you're into real estate, it would be sale of immobile assets, any property or land that you sold during the year. A lot of individuals obviously are into capital market transactions. So any sale of shares, debentures, any other financial instruments, equity or any other mutual fund that you may have sold during the year, or any other capital asset that you can think of. Largely, this would comprise income under the head capital gains. In fact, one thing I wanted to point out was, and it's a commonly observed fallacy, because most of us invest in mutual fund transactions, that we've seen that, individuals, when we switch from one mutual fund scheme to another, if it falls within the same mutual fund, we somewhere believe that, it's not a capital gain transaction. But that actually is a myth, because the switching in and switching out of the mutual fund schemes is also exposed to capital gains taxation. And very often we've seen, from a tax perspective, individuals lose sight of such transactions, which could also fall under the ambit of capital gains.
Okay, Parizad, if you could detail for us when it comes to real estate, what are the kinds of income from house property that I should be reporting under ITR-2? What if I have bought a house, or what if I have sold a house? So within real estate investments, if you could elaborate the important points that need to be reported.
Sure. First of all, we should know that anyone who buys or sells a house property in India, which is above a particular threshold value, stamp duty value about 30 lakhs, gets automatically classified as a high value transaction. And you know that when you go to the registrar, it is, your PAN and all is swiped. So there's clearly a record with the registrar and the income tax department. So
Right.
the same is automatically reflected, definitely going to be reflected in the first case in your AIS and 26AS. Now it's an income tax return form in India, including ITR-2, is just not for your income disclosures. It is also, we have schedules for asset disclosures as well. So there are schedules called Schedule AL. If your income is above 50 lakh of rupees, then first of all, any property purchased, your assets also form part of the disclosure. Okay. To your specific question with respect to purchase and sale of property, there is a detailed schedule called HP schedule, income from house property in ITR-2. And in fact, even if the property is lying vacant or it's self-occupied, it has to be reported as a self-occupied property with nil income. Similarly, if you're selling the property and there is a capital gains that you've incurred on the sale of the property, then there are separate capital gain detailed schedules in ITR-2, specifically Schedule CG. And if the sale is, of course, taxable in India, and there are a whole host of details which have to be disclosed. And either you made short-term capital gains or you made long-term capital gains, depending on the classification of the gains. A lot of details like date of sale, date of purchase of the house property, the purchase price that you've paid, the sales price, brokerage charges, and various other such details have to be disclosed in those relevant schedules, including things like the name and the permanent account number of the seller, the stamp duty value of the property. Everything is required to be filled in.
Right.
Very often individuals sell a property, they want to invest and purchase another property or invest in certain specified bonds to get what is called certain exemptions or rollover relief from long-term capital gains, popularly in tax the section 54 exemptions. If you're claiming those exemptions by investing in another house property, then those disclosures are separate. Ultimately, if all this results in a loss from the sale of the property and you want to carry forward that loss for set off against the future years, then there are separate schedules in ITR-2 for carry forward of those loss from house property. And there are various details, to be disclosed therein as well, in case because the future loss you would want to offset against future capital gains, if any, and there's a time period of 8 years specified. Similarly, these days, real estate transactions at times are also subject to tax deduction at source at the first level. So if you happen to have a TDS element, then the TDS that gets disclosed in the relevant TDS schedule, so on and so forth. So whole host of schedules relating to your property related transactions, depending on the number of properties you hold and whether you are purchasing, selling, what is the ultimate, calculation there.